Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Mathew. Late last week, there was an important notification that was sent out by the government through a gazetted notification. And this has to do with your contributions to the Employee Provident Fund and the rules that govern it. One of the headlines that must have caught your attention, of course, is the fact that you can now officially limit your contribution to the Employee Provident Fund to 1,800 rupees. But let's get into the details. And it's not just that change. There are also changes with regard to the withdrawal that you can get from the EPF, as well as how much, if at all, goes to what is called the Employee Pension Scheme. This is what your employer contributes on your behalf. We'll talk about all of that, and we'll talk about what you should do if you are indeed to limit your contribution to 1,800 rupees. Joining me today is Harsh Kumar of Zvest Financial Services. Thanks so much, Harsh, for taking the time for speaking to me. Let me first ask you what you made of that gazetted notification, because obviously the first headline is that you can now limit your contribution. But my understanding is that this already existed in the form of an interpretation. They've just made this clearer. We'll talk about that, and then we'll go into the liquidity and certain other things.
Right, Alex. Thank you so much for having me. And you rightly said that it's a clarification with respect to the 1,800 rupees. But, we have been giving all the attention to that part, ignoring what are the other aspects of this notification. So let me get things straight. This looks like any other EPF notification, but I think it's much bigger than that. It's actually the final piece of a much larger labor reform puzzle that began with the last year's new labor codes. Now, there's an extension of labor code that came into effect in November 2025, where we had 29 existing labor laws, which were consolidated into 4 labor codes. And you have discussed it enough on your channel as well. Now, one of the key outcomes of that was a very clear definition of wages, which was still at that point of time not very, very clear. Now, today, the definition says that 50% of an employee's CTC is classified as wages. Now, once we have the definition of wages with us, we need to work on what should be the PF contribution, because this is a part of that Social Security Code 2020. Now, before that, why is it that we are all discussing it so much? And the reason is that we have close to 7 to 8 crores active contributing members in EPF at this point of time, which means it's very, very important for a lot of people in the country. And that's the reason I think we should give it due attention. Now, let's look at the changes which have happened. First is on the PF contribution, which is getting a lot of media attention. Now, the new schemes make it very clear that the employees and the employers are required to contribute 12% up to a notified wage ceiling of rupees 15,000, which works out to be 1,800 rupees per month. Any contribution beyond this, both for employee and employer, is voluntary. For example, if your basic pay plus DNS announced, which is your wage, is 1 lakh a month, then earlier there was an ambiguity whether you should be paying 12,000, employees should be paying 12,000. Under the new rules, 1,800 becomes a number which you can work at. If you are looking at higher number, then it has to be a mutually agreed number between employee and employer. Now, another good thing which they have done is that this 15,000 wage ceiling is not hard-coded into the scheme. The notification refers that wage ceiling as notified by central government from time to time. So allowing it, that in case there is an inflation in future, which it would be, they can keep changing this number also. Second thing, the withdrawals have become much simpler. Now, if you go back in time, if you would invest into Provident Fund for 10 years, 15 years, and you needed money because of certain health contingencies, or you were buying a house and you needed to make payment for that, or your son or daughter gets admission into a good university and you need money for that, it was a very cumbersome process because there were multiple definitions associated with that. Now they have simplified it a lot. Now the number of withdrawal categories have been shrunk from 30 to just 3, which is essential needs like illness, education, marriage. Second is housing needs like purchasing a house, constructing a house, or repayment of loan. And third is special circumstances. Now, members can withdraw up to 100% of their eligible balance. So they have to keep 25% in the fund, and remaining eligible amount, they can withdraw up to 100%. And the minimum service criteria, which was earlier 5 to 7 years for different categories, has also been reduced to 12 months. Third is the liquidity has improved. Now, under the new rules, if you are withdrawing, you have to get under auto payment mechanism money within 3 days it can be extended up to 20 days. But if within 20 days you don't get the credit and there is no reason which is given to you as to why there is a delay, you get a penal interest of 12% on that, which is higher than 8.25% which you get in your provident fund. Fourth is the flexibility with respect to early retirees. So earlier the definition of retirement age was 58. Now, if you're retiring at any age after 55 years, you can withdraw 100% of your corpus. So in summary, if you ask me, the notification introduces a lot of flexibility, both in deciding between a higher take home, higher EPF contribution, and also in accessing one's retirement corpus. But the core still remains the same. The 12% contribution structure, UAN, tax treatment, interest mechanism, portability, everything else remains the same.
You know, I want to focus though, and I think understandably, Harsh, a lot of attention has gone to this 1800 contribution because it has implications on every month's take home, right? Because even if you look at your definition, if you're talking about your 12% of 1 lakh rupees, then you're talking about 12,000 rupees that would go from your end and another 12,000 rupees that your employer would contribute on your behalf. Now what would happen is if you limit to 1800 rupees, then effectively about 10,200 rupees multiplied by 2 would come to you. And of course, you're paying tax on the 12,000 that you contribute in the new tax regime. And you're not paying tax on what the employer is contributing. So net of tax, effectively, that 10,000 rupees that you contribute and 10,000 odd that your employer contributes can come to you in hand?
Yes. So let's understand this a little more holistically. So, when you are restricting your contribution to 1800, the first thing, like you mentioned, is you get a better take home. But from a tax perspective, we need to look at it from 3 different dimensions. First is new tax regime versus old tax regime. So under the old tax regime, the employee's EPF contribution also classifies for Section 80C, which is not there in new tax regime. Now, if I look at this, then, we may say that, there are a lot of people in India who may benefit out of this by paying their contribution on the higher side. But if I go by the last interview of CBTT chairman, I think this was in Feb or March, where he mentioned that 88% individuals have already moved to new tax regime. So there is not too much of a tax advantage there. Second is about the employer contribution. Now, employer contribution in EPF, NPS and superannuation up to a combined limit of 7.5 lakhs per year remains tax-free. So if you are below this threshold and your employer reduces its EPF contribution because of the new rule, now the key question is what happens to the money that is no longer being contributed? So is that amount being simply added to your salary? Then definitely it becomes taxable. But on the other hand, if the employer is routing it via other instruments like NPS, etc., there are still benefits which can be accrued to that. Third is also about individuals' contribution. Now, there was a budgetary change which was done in 2021 budget, which said that if you are contributing as an employee 2.5 lakhs in a financial year in EPF, then the interest is tax-free. But if you're contributing more than that, then your interest becomes taxable. So it depends on where you stand in terms of the contribution that you are doing. If it is more than 2.5 lakhs, then, the taxability changes accordingly. So what is the bottom line? I mean, I won't say that 1800 is good or bad. The real impact depends on whether both the employee and employer, how do they decide to structure it going forward.
You mentioned NPS, and it's important to make that point because you said that from the employer's contribution, Harsh, up to 7.5 lakh rupees, EPF plus NPS plus superannuation. And here I'm guessing that this has to do with gratuity contributions. Is that what it means?
Yes, that's what I meant.
So that is 7.5 lakhs, right? So you can actually ask in the new tax regime for your EPF contribution to be brought down to 1800 rupees, hypothetically. And you can say that what you were contributing to the EPF or your employer, what they were contributing on your behalf to the EPF, you can actually make that contribution to the NPS instead, bring your contribution down to 1800. So to that extent, you're in hand. In our previous example, we were talking about 10,200 rupees. Then that per month is what your in hand goes up by. And that 12,000 rupees or minus 1,800, which is 10,200 rupees per month, can go into NPS instead, and you'd still not be paying tax on that 10,200, correct?
Right. So if we have to analyze the benefits of moving to NPS, I think that is what you are intending to go to, and let me take that. So first thing first, I would say that these are relatively different categories. So if I look at EPF, it is a pure play debt instrument, whereas NPS has a lot more variety. So I would say that both are complementary strategy. So what are the benefits? So first is, like I was alluding to, it is an asset allocation mix. So if you are doing NPS, you can take equities, you can take corporate bond, you can take government bond, and now they have a provision to add alternative assets also. So which means you are doing a much more holistic allocation of your retirement corpus rather than keeping it only in debt, which is the case with EPF. Second is a tax efficiency, which is available in new tax regime also. So if you look at new tax regime, what are the different options which are available to you to avoid taxes on certain heads? You don't have many options, but in NPS, you have that provision under Section 80 CCD, where an employee contribution to NPS up to the prescribed limit of 14% of basic salary and dearness allowance is eligible for tax benefit. Obviously, we have to keep in mind that 7.5 lakh number in kind, but the only clause here is that it has to be a corporate NPS structure. So as an individual, you don't have much play to do unless your corporate also is in sync with that and they have an NPS structure which you can use. So I would say that, if you have an option where you can move your money to NPS via your corporate and you're not breaching that 7.5 lakhs, I think it's a very, very good instrument to look at.
Very interesting. So therefore, and this is hypotheticals, right, that we're talking about. If you are in a slightly lower end of the tax-paying income, right? So if you're around that 12 lakh mark, where you're not paying tax, then this might actually make sense for you to say that your in-hand goes up and your tax incidence does not change at all, right? Would that be fair?
So, yes. So this 12 lakhs tax-free can actually get extended to slightly more than 13 lakhs for somebody who's using this provision of NPS. So you don't have many other options, like I was saying, available in a new tax regime, but this NPS helps you increase it by another 1 lakh as far as your tax-free income is concerned.
But, so even just not counting the NPS, and we'll talk about the pros and cons of each of these decisions, but if I were to say that you limit both my contribution and the employer's contribution to 1,800, then net of tax of what the employer's contribution would be, my take-home would go up by that extent, right? To say that if I am in the highest tax bracket and I'm paying 30% tax, then the contribution that the employer was making, that would be taxed at 30%, but hypothetically, my in-hand would go up quite substantially. Would that be fair?
Yes. So, Alex, now what you do with that in hand decides how, your life, retirement goals and everything plays out.
Yeah.
Because if you look at intuitively, you are getting more money in your hand. And if you invest it wisely, it makes a lot of sense. But there is a lot of behavior element which gets involved. So I would not suggest somebody to only look at increasing the take-home salary. One has to look at one's individual profile and behavior before taking that decision. And I'll tell you an irony here. People who are in lower income slab, they want EPF contribution to be on the lower side. They want higher take-home. But if I look at ultra HNIs or HNIs, they actually still keep on contributing to voluntary, and they would keep on contributing because they see the benefits of this versus other conventional product. Even if the interest is taxable beyond 2.5 lakhs of their contribution, they still keep on contributing. So I think one has to look at it very holistically, depending on where individuals stand, what are individual behavioral pattern, and then take a call on that.
That's a fair point. You know what? We'll discuss this after a very quick break, Harsh. The various scenarios that could follow. One, of course, is keeping your money in the EPF, and the others, if you cap your EPF contribution to 1,800, what should you do with the surplus? We've been talking about the recent changes to the rules that govern your employee provident fund if you're a salaried employee. And we've discussed what all of those changes entail. Let's talk about the various options available to you as things stand. Harsh, Kumar is in conversation with me. Harsh, the various options available. First, you keep it going as it has been going, which is you contribute the entire amount. What is the benefit and what is the negative aspect of this?
So, Alex, let's look at what are the options available for any individual. So one is you spend, Second is you invest, or third is look at a combination of both of these. And my worst fear is that it should not be taken as a salary hike, because many investors or many individuals may assume this extra cash flow as a salary hike also, and they may take a bigger loan, include more EMIs in their portfolio, which may be good for them in the short term but may be harmful for them in the long term.
But before we do that, Harsh, I want to take it one by one. I will take you through the
Right.
various options. I want to first discuss the option of not doing anything, of allowing your contribution to continue at 12% of the wage as it is described. What are the pros and cons of continuing to contribute to the EPF?
Right. So, Alex, first thing first, like we discussed, that 2.5 and 7.5 limit for individual and employer. But if you're continuing in EPF, one of the biggest advantage here is that you're getting a rate of interest, which is fairly significant. So we are looking at 8.25% rate of interest. Now, imagine you are earning 20 lakhs a year. Going by your marginal tax rate of 20% at that rate, this 8.25 is as good as 10.3% available to you in a fixed deposit, with slightly higher safety, I would say, because it's backed by Government of India, AAA rated instrument. So one thing is that, it's a very good instrument from a return point of view for somebody who's looking at fixed income as an allocation. Second is that it's a forced discipline on individual. Now, today, the problem is many young investors, they don't have the discipline of investing on a regular basis. And here, you don't see credit in your bank account. The money keeps on getting invested. And at some point, it becomes big corpus for you, which you don't even realize. Third thing is that here, you don't have a behavior gap playing against you. Now, let me take 1 minute to explain what is behavior gap. So the problem in most of the asset classes today is that there is a return which asset class generates. There is a return which investor makes, and there is a difference between that. So, for example, equities would have given 14% return in last, 5 years, for example. But individuals would not have made, because many of them would have done panic selling, many would have done, buying at higher level, and those kind of things keep on playing. Here, in case of EPF, you don't have those problems coming in because it's a long-term investment and forced upon you. You don't even want to break it, because the avenues to break it earlier were very, very difficult. Like I mentioned, 5 to 7 years was a time period which was there for you to come out of it. So that's the reason I feel that it's a very, very strong asset allocation mechanism, which is disciplined, and it ensures that one is invested for long term.
Okay. What about the cons, though? Because here you're talking about a situation where the rate is determined, of course, by on a yearly basis. It's at 8.25%, as you pointed out. It was allowed because 15% is going towards equity, right? At this juncture, it could be revised upwards down the line. And there has been certain conversation to that end. But most of this, as you pointed out, is in fixed income instruments. So there is a possibility that down the line, depending on the interest rate scenario in the market, you could have a lower than 8.25% rate, right?
Absolutely. So one of the negatives where I see is that it's not a holistic retirement product, because the portfolio is skewed toward fixed income. And if you are in your 20s and 30s and you're looking at next 30 years of contribution to Provident Fund, there you are missing the opportunity of participating in the India growth story through equity. So that is one limitation. Second limitation is, which is not often discussed, the withdrawal in EPF is very, very cumbersome. I'll just give you the data point for 23-24, because we don't have the data points available after that for this particular thing which I'm discussing here. The rejections for EPF claims, when individual filed for it, was 26% in that financial year. And what were the reasons? KYC mismatch, bank details not updated, UAN compatibility being an issue. Now, for an individual who has worked hard, saved enough, and then he or she wants to redeem or withdraw the money, and you are in a situation where your claim is rejected, and then you have to go from pillar to post. In fact, there are people who have created business model around it, where they say that you are not getting your EPF money, come to us, we will help you take that, which is not a desired situation. Ideally, the liquidity should be available for an individual. Third, I would say, is the flexibility. Let's say you are 30, 35. You want to do something in terms of your skill enhancement, other things. If you have a portfolio which is fairly liquid, you can take those kind of initiatives. You can upgrade your skill. You can move up the hierarchy in your corporate or outside that. Where in EPF, you have those limitations because there is a lot of friction required for you to take that money out. And these are some of the cons which are there for EPF.
Yeah. Okay. So if you're not doing a continuation of the EPF contribution, if you decide to cap it, what are your various options available? One is, of course, to increase your take home. And you've described why that's not necessarily the best idea for somebody who's really disciplined and who can make the right choices, then they can invest. But what are the other options available in your opinion?
So first is NPS through your employer, because it's a very, very good instrument. And why I see it's a very good instrument, because A, the return is over a longer period of time could be better than that 8.25%. Second, it also has a taxation efficiency in terms of when you are withdrawing it. And thirdly, the expense ratio in this is very, very low. I mean, while we speak today, in case of NPS, the expense ratio ranges from 3 basis point to 9 basis point. Now, if I compare that with developed market, Vanguard runs an expense ratio of around 0.05 to 0.07% on its funds. If I look at iShare, which is again a very, very strong ETF provider, there the expense ratio is even higher. So we are having a product which is globally competitive with respect to expense ratio and in terms of developed market as well. Second option for you is you start contributing to PPF. But here I would not recommend that, because on one hand, you are reducing the allocation in EPF and then you are adding to PPF. It's the same thing at the end of the day. So it looks like a little counterintuitive to me. Third is you start investing into mutual fund through SIPs. If you are a younger person and if you want to build the portfolio for long term, you can decide a combination of flexi cap fund, mid cap fund, large cap funds. You can put money into that. Fourth, which you can work upon, is that you can also strengthen your emergency corpus, because I have seen a lot of people who have money in EPF, but in short term, they run into issues like personal loans, BNPL, taking P2P loans. These kind of things can be avoided because one can get more liquidity and get a handle on emergency fund. And so I would say that, depending on where your age is, what profile you have, what your aspirations are, you can decide which option do you want to take.
And specifically on the NPS, there are quite a few changes that have been introduced, Harsh, to make it more viable as well, right? Including the flexibility when you're choosing what form of NPS you invest in. And also with regard to the withdrawal, they made it so that you can withdraw 80% as a lump sum as opposed to 60% earlier, right?
Right. So, Alex, we have discussed this 2 times earlier in this conversation. I will repeat it again for the benefit of the viewers. Yes. Is the tax efficiency at the time of investment. This is not available in any other instrument in new tax regime. So I would request all the viewers to look at it very seriously, which is up to 14% of your basic salary plus dearness allowance continues to enjoy tax benefit. And we discussed that 12 lakhs can become 13.1 or 13.2 lakhs in terms of being tax-free component for you. Second is flexibility at retirement, which you touched upon. So earlier you could withdraw 60%. Now they have increased it to 80%. But you should be careful about it that the tax-free withdrawal is still 60%. The incremental 20% that you're withdrawing is liquidity provider for you, but it's not tax efficient for you. So there, you have to take annuity for 20% to 40% of that. Third is the platform in itself has become much mature. Today, if I look at it, in 2016, they introduced the concept of adding alternate investment to that. Now, for a retail investor, taking exposure to alternate investment is not easy. And here you have somebody doing due diligence for you and giving you exposure in that at a smaller ticket size also. Second, the number of providers in this have increased. So while we speak, I think there are around 11 to 12 providers. So it's not that you are married to a single pension provider. You can choose with whatever you want to go. You can track their performances and you can do. Lastly, it has an option of auto choice versus active choice, which means you are an investor who doesn't understand the market dynamics. You are not sure about how much debt equity should be there in the portfolio or how should you change it over a period of your working life. You can choose auto choice, where as your age keeps on increasing, the portfolio keeps on becoming less and less aggressive. It's like a lifestyle fund, which even mutual funds are going to introduce, I think, in this year or next year. So I think these are the few benefits which have come up in NPS. I think it was started in 2003. And if I look at the current structure of NPS, it has undergone a tremendous change for the benefit of investor. And I would urge all the investor to look at this product also in a very, very conscious way.
So Harsh, here's my suggestion. There's a lot that we still have to talk about with regard to the NPS. We've, of course, done quite a bit to set the context. I think in a future episode, we can discuss the pros and cons of each of the options available under the NPS so that people can make an informed decision on that. Thank you so much, though, today for taking the time and for speaking to me.
Thank you so much, Alex. Thanks for your time.
All right, so if I were to wrap things up, well, there is a distinct advantage if you were to cap your investments into the EPF, particularly if you've already migrated to the new tax regime, because of the tax saving that you can take up if you were to migrate a portion of that contribution, that is your employer's contribution, to the national pension scheme. I hope that that is clear from the conversation that we've had, but if you've got questions for us, then you can write to us on any one of our social media platforms, or in fact in the comment section, and we'll take it up in future episodes. Thanks so much for watching. This is NDTV Profit.